right now, while you're scrolling through your feed and checking your bank balance, while financial news channels are telling you the economy is recovering and everything is fine, the largest banking cover-up in modern history is happening in plain sight. And here's what should terrify you. This isn't about one bad bank or one risky investment. This is about a $1 trillion hole in the foundation of the entire banking system that regulators know about, that bank executives are desperately trying to hide, and that will eventually consume the savings of millions of Americans who think their money is safe. Before this video ends, you'll see the exact mechanism they're using to hide these losses, why the traditional safety nets won't save you, and why the people who know the truth aren't warning anyone. In 1984, Continental Illinois was the 7th largest bank in the United States. They had assets worth over $40 billion, and they were considered one of the most sophisticated, well-managed banks in the country. Their lending practices were studied in business schools as examples of excellence, and beneath that polished surface, they were sitting on $4 billion in bad loans they had hidden from regulators, from investors, and from their own depositors. Sound familiar? By May of 1984, rumors started spreading that Continental Illinois was in trouble. Within 3 days, depositors withdrew over $6 billion. The bank collapsed. The FDIC had to step in with the largest bank bailout in American history at that time. Depositors got their money back, but shareholders were wiped out. Bondholders took massive losses, and the American taxpayer footed the bill. In 2007, Washington Mutual was the largest savings and loan institution in the United States. They had $188 billion in deposits, and they operated 2,200 branches across the country. Millions of Americans trusted them with their life savings, and behind the scenes, they had loaded their balance sheet with subprime mortgages that were defaulting at catastrophic rates. They had used accounting tricks to hide the extent of the damage. When the truth finally came out in September 2008, Washington Mutual experienced the largest bank run in American history. Depositors withdrew $16.7 billion in just 10 days. The bank failed. It was seized by regulators and sold to JPMorgan Chase for $1.9 billion, a fraction of what it had been worth just months earlier. Shareholders lost everything. In 2023, Silicon Valley Bank was the 16th largest bank in the United States. They had $209 billion in assets. They were the bank of choice for tech startups and venture capital firms. They passed every stress test. They had received clean audits. Their executives had sold millions in stock just weeks before the collapse, which should have been a warning sign, but nobody paid attention. And they were sitting on $15 billion in unrealized losses on their bond portfolio that they had hidden using a legal accounting loophole. When word got out, depositors withdrew $42 billion in a single day. The bank collapsed in less than 48 hours. It was the second largest bank failure in American history. 3 banks, 3 different eras, 3 catastrophic collapses, and every single time the banks knew they were in trouble, long before anyone else did. Every single time they used accounting tricks and regulatory loopholes to hide the truth. Every single time. Ordinary depositors were the last to know. And every single time, by the time the truth came out, it was too late to save your money. Now let me show you something that should make your blood run cold. In 2026, American banks are sitting on over $1 trillion in unrealized losses. $1 trillion in losses that exist on their balance sheets but don't appear in their earnings. Reports $1 trillion in assets that are worth far less than what the banks claim they're worth, $1 trillion in holes that regulators can see, that bank executives absolutely know about, but that aren't being disclosed to the public in any meaningful way. This isn't speculation. This isn't conspiracy theory. This is data from the Federal Reserve's own reports. And if you're not terrified by this number, you don't understand what it means. Before we go further, if you value analysis that doesn't sugarcoat the truth, that treats you like the intelligent person you are, hit that subscribe button. Because when this situation unravels, and history says it will, you'll want to understand what's happening and why nobody warned you. Drop a comment with where you're watching from, because I want to know who was paying attention when the warning signs were everywhere, but the media was silent. Let me take you back to 2020, because that's when this crisis was born. In March 2020, when the pandemic shut down the global economy, the Federal Reserve made a decision that would create the largest hidden time bomb in banking history. They cut interest rates to 0, not to 1% or 0.5%, to 0. And they started buying bonds, trillions of dollars worth of bonds, to pump money into the financial system and prevent a complete economic collapse. It worked in the short term. The stock market recovered. Businesses got loans, the economy stabilized, but it created a massive problem that's coming due right now. When interest rates are at zero, bonds are incredibly valuable. Think of it this way. If you own a bond that pays 3% interest, and new bonds are only paying 0%, your bond is worth a premium. People will pay extra to own it because it's paying more than anything else available. Banks bought trillions of dollars worth of these bonds in 2020 and 2021. They loaded up their balance sheets with long-term treasury bonds and mortgage-backed securities that were paying 2, 3, 4%. At the time, it seemed like free money. The bonds were safe, the yields were decent, and they could hold them to maturity and collect the interest. Nothing could go wrong, except everything went wrong. In March 2022, inflation hit 9%, the highest level in 40 years. The Federal Reserve panicked. They started raising interest rates faster than they had in decades, from 0 in March 2022 to 5.5% by July 2023. The fastest rate hiking cycle in modern history, and every time the Fed raised rates, the bonds that banks were holding became less valuable. It's basic mathematics. If your bond pays 3% and new bonds are paying 5.5%, nobody wants your bond anymore. They want the new ones paying higher rates. So the value of your bond falls. It has to fall enough that the effective yield matches the new bonds. This is called mark-to-market. And for the banking system in 2024 and 2025, mark-to-market has been a bloodbath. The bonds that banks bought for $100 in 2020 are now worth $80, $70, sometimes $60. Banks are sitting on hundreds of billions in losses on these bond portfolios. And here's the key, the absolutely critical detail that most people don't understand. As long as banks don't sell these bonds, they don't have to recognize the losses. This is the accounting loophole that's hiding the crisis. It's called held-to-maturity accounting. Banks classify their bonds into two categories: available for sale, which have to be marked to market every quarter, and held to maturity, which can be carried at purchase price regardless of what they're actually worth right now. The idea is that if you're planning to hold a bond until it matures, the current market price doesn't matter because you'll eventually get the full face value back. It's a reasonable accounting principle in normal times. But these aren't normal times, and banks are exploiting this loophole to hide massive losses from depositors, from investors, and from anyone paying attention. Silicon Valley Bank had $91 billion in held-to-maturity bonds on their books. They claimed these bonds were worth $91 billion. In reality, if they had to sell them, they were worth about $76 billion. That's a $15 billion loss that wasn't showing up anywhere in their official financial statements. When SVB needed cash to meet deposit withdrawals, they had to sell some of these bonds, and that's when the loss became real. They had to recognize a $1.8 billion loss on the sale. That spooked depositors. Depositors started withdrawing money, which forced SVB to sell more bonds, which created more losses, which spooked more depositors. The death spiral had begun. Now scale that problem across the entire banking system. According to the FDIC's own data, American banks are holding $1.1 trillion in unrealized losses on their bond portfolios as of the fourth quarter of 2024. Let me repeat that. $1.1 trillion. These are bonds that banks bought when rates were low that are now worth far less because rates have risen. But the losses aren't showing up in earnings reports because the banks have classified them as held to maturity. The banks are essentially saying, we're never going to sell these bonds, so the losses don't count. But here's the problem. Banks aren't normal companies that can just hold assets forever. Banks need liquidity. They need to be able to convert assets to cash quickly when depositors want their money. If a bank has $100 billion in deposits, but $80 billion of their assets are tied up in bonds, they can't sell without taking massive losses. That bank is functionally insolvent. They just haven't admitted it yet. This brings us to First Republic Bank in 2023. First Republic was a darling of the banking industry. They served wealthy clients in expensive neighborhoods. Their default rates were low. Their loan quality was excellent. They had a reputation for conservative, careful management, and they were sitting on tens of billions in unrealized losses on their bond portfolio that they had hidden using held-to maturity accounting. When Silicon Valley Bank collapsed in March 2023, depositors at other regional banks started getting nervous. They started asking questions. Are my deposits safe? Does my bank have the same problems as SVB? First Republic tried to reassure everyone. They disclosed some of their unrealized losses, but downplayed the severity. It didn't work. Wealthy depositors, the kind who have accounts well above the FDIC insurance limit of $250,000, started moving their money to JP Morgan Chase and Bank of America. banks that seemed too big to fail. Within weeks, First Republic had lost over $100 billion in deposits. They tried to raise capital. They tried to find a buyer. Nothing worked. In May 2023, regulators seized First Republic and sold it to J.P. Morgan Chase. It was the third largest bank failure in American history. Shareholders were wiped out. Bondholders took significant losses, and the American banking system learned absolutely nothing from the experience. Because here's what nobody wants to talk about. First Republic wasn't an outlier. Silicon Valley Bank wasn't a uniquely badly managed institution. They were canaries in the coal mine. They were the first to fail because they had specific vulnerabilities. SVB had a concentrated deposit base of tech startups that all pulled their money at once. First Republic had wealthy depositors who could move money quickly. But the underlying problem, the massive unrealized losses on bond portfolios, exists across the entire banking system. According to research from Stanford University and Columbia University, as of mid-2024, over 200 American banks have enough unrealized losses that they would be insolvent if they had to liquidate their assets at current market prices. 200 banks, not tiny community banks with a few million in assets. We're talking about regional banks with tens of billions in deposits. Banks that millions of Americans trust with their savings, their business accounts, their mortgages. All of them are sitting on time bombs that could explode the moment depositors start asking questions. Now let me show you the second layer of this crisis, the part that makes it exponentially more dangerous: commercial real estate. For decades, commercial real estate was considered one of the safest lending categories for banks. Office buildings, shopping centers, apartment complexes, these were stable assets that generated predictable cash flows. Companies needed office space. People needed retail stores. The loans were secured by valuable property. What could go wrong? The pandemic changed everything. Remote work became permanent for millions of Americans. Companies realized they didn't need massive downtown office towers anymore. They started reducing their office footprint, breaking leases, moving to smaller spaces. Office vacancy rates in major cities hit 20%, 25%, sometimes 30%. Buildings that were worth $100 million in 2019 were suddenly worth $60 million in 2024. And the mortgages on those buildings were still based on the old values. A bank that lent $70 million against a building worth $100 million was fine. That same bank lending, $70 million against a building now worth $60 million, is underwater. The same pattern is playing out in retail real estate. E-commerce has been destroying brick-and-mortar retail for years, but the pandemic accelerated it. Shopping malls are dying. Strip malls are half empty. The stores that remain are struggling. Property values have collapsed, and banks hold the mortgages. According to Goldman Sachs research, American banks hold approximately $2.7 trillion in commercial real estate loans. About $1.5 trillion of those loans are for office properties and retail properties, and the two sectors getting destroyed right now, even if only 20% of those loans default, which is conservative. Given the structural changes in how Americans work and shop, that's $300 billion in losses. But here's where it gets worse. Most commercial real estate loans were made in 2020 and 2021, when interest rates were near zero. These loans are now coming due. They need to be refinanced. The property owner goes to the bank and says, I need to refinance my $70 million loan. The bank does a new appraisal and discovers the property is now worth $60 million. They can't refinance $70 million against a $60 million property. So the property owner has two choices: come up with $10 million in cash to pay down the loan, or default. Most can't come up with the cash, so they default. When they default, the bank takes ownership of the property. But what's the bank going to do with an empty office building in downtown San Francisco or a half-empty shopping mall in suburban Ohio? They can't sell it for anywhere near what they lent against it. They can't find new tenants because nobody wants office space or retail space, so it sits on their books as a non-performing asset, generating no income, declining in value, and representing a massive loss the bank hasn't recognized yet. New York Community Bank in early 2024 shocked the market when they disclosed huge losses on commercial real estate loans and cut their dividend by 70%. Their stock crashed, depositors got nervous, other regional banks with heavy commercial real estate exposure saw their stocks fall in sympathy, and here's the terrifying part. New York Community Bank wasn't doing anything unusual. They were just being honest about their commercial real estate losses earlier than other banks. The losses exist across the industry. Most banks just haven't disclosed them yet. When you combine the unrealized losses on bond portfolios, over $1 trillion, with the emerging losses on commercial real estate loans, potentially $300 billion or more. You have a banking system sitting on $1.30 to $1.5 trillion in hidden losses. That's losses that exist but haven't been fully recognized. Losses that could force banks to raise capital, cut dividends, reduce lending, or in the worst cases, fail entirely. And the regulators know, the Federal Reserve knows, the FDIC knows, the Office of the Comptroller of the Currency knows. They publish reports every quarter showing the unrealized losses. They conduct stress tests that are supposed to determine if banks can survive economic downturns. But the stress tests are designed to pass banks, not to expose problems. Because if regulators admitted how fragile the banking system is, it would trigger the very panic they're trying to prevent. This is the paradox at the heart of banking regulation. If you tell the truth, you cause a crisis. If you hide the truth, you let the crisis grow bigger. Regulators have chosen to hide the truth. They're betting that interest rates will come down, that bond values will recover, that commercial real estate will stabilize, and that banks can grow their way out of these losses over time. It's a dangerous bet because it assumes nothing goes wrong. It assumes depositors remain calm. It assumes the economy doesn't enter recession. It assumes no external shock hits the system. History says that's a bad assumption. Something always goes wrong. Let me show you what happens when depositors lose confidence. In a normal bank run, depositors physically line up outside the bank demanding cash. It takes days or weeks to drain a bank. You saw this in the Great Depression. Long lines of people waiting to withdraw their savings. Banks could sometimes survive because the lines moved slowly. Modern bank runs don't work that way anymore. In March 2023, Silicon Valley Bank lost $42 billion in a single day. Not over weeks or months. One day. How digital banking depositors didn't need to go to a branch. They logged into their accounts on their phones, initiated wire transfers to other banks, and the money was gone instantly. Venture capital firms sent emails to all their portfolio companies saying, "Get your money out of SBB." Within hours, billions were moving. The bank couldn't stop it. They couldn't slow it down. By the time regulators understood what was happening, it was over. The bank had failed. This is the new reality of banking. In an era of instant digital transfers, a bank can be solvent on Monday morning and insolvent by Monday afternoon. There's no time for regulators to arrange an orderly rescue. There's no time for other banks to provide liquidity. There's no time to reassure depositors. Once the panic starts, it's over in hours. And here's what makes this crisis different from 2008. In 2008, the problem was bad loans to homeowners who couldn't pay. It was a solvency crisis. Banks had made stupid loans and the losses were real. But most banks still had functioning business models. They could raise capital, write down the bad loans, and rebuild. The government could inject capital through TARP and stabilize things. This crisis is different. This crisis is about the fundamental business model of banking being broken by the interest rate environment. Banks borrow short and lend long. That's what they do. They take deposits that can be withdrawn anytime, and they make loans, or buy bonds that mature in years or decades. This works when interest rates are stable. It breaks when rates rise fast. When rates were at zero, banks could pay depositors 0% on savings accounts and earn 3% on bonds. That's a nice 3% spread, but now depositors can get 5% on money market funds. They can get 5.5% on treasury bills. Why would they leave money in a bank account paying 0.5%? They wouldn't. They're moving money out of banks and into money market funds. This has created a deposit crisis. Banks are losing deposits to money market funds. To keep deposits, banks have to raise the rates they pay. But the bonds they bought at 3% are still only paying 3%, so their profit margins are getting crushed and they're paying more for deposits while earning the same on their assets. This is financially unsustainable. Banks need the interest rate differential to make money, and that differential has collapsed. The Federal Reserve created this mess. They held rates at zero for too long. They encouraged banks to load up on bonds, and then they hiked rates faster than any time in modern history. They broke the banking system's business model, and now they're hoping banks can survive long enough for rates to come back down and fix things. But here's the problem. The Fed can't cut rates much because inflation is still elevated. And even if they do cut rates, it doesn't fix the losses that already exist on bank balance sheets. Those bonds that lost 30% of their value don't magically recover. A 3% bond is still a 3% bond. Even if new bonds are only paying 4% instead of 5.5%, the losses are permanent unless the bank holds the bond to maturity, which could be 10 or 20 years. Banks don't have 10 or 20 years to wait. Now let me show you the three scenarios for how this plays out. Scenario 1 is the soft landing. The Fed manages to bring inflation down without causing a recession. Interest rates gradually decline. Banks hold their bonds to maturity and avoid recognizing losses. Commercial real estate stabilizes and stops deteriorating. Depositors remain calm. Banks slowly rebuild their capital over several years. Everything works out fine. This is what regulators are hoping for. It requires everything going right simultaneously. No recession, no external shocks, no loss of depositor confidence. History says this is unlikely. Scenario 2 is a rolling crisis. Banks fail one at a time over several years. Each failure causes temporary panic. Regulators step in, arrange sales to larger banks, protect depositors. The system slowly consolidates, smaller regional banks disappear, the big banks get bigger. Depositors eventually lose faith in anything except the absolute largest institutions. We get a banking system dominated by 5 or 6 mega banks that are explicitly too big to fail. This seems most likely based on what we've seen in 2023 and 2024. It's painful but manageable. Scenario 3 is systemic collapse. Something triggers a widespread loss of confidence in the banking system. Maybe it's a major bank failure. Maybe it's a geopolitical crisis. Maybe it's a recession that causes both commercial, real estate losses and bond losses to hit simultaneously. Depositors panic and start pulling money from any bank that seems remotely risky. The digital bank run becomes system-wide. Hundreds of billions flow out of regional banks. In a matter of days, banks are forced to sell their held-to-maturity bonds at massive losses. This creates a solvency crisis. The FDIC doesn't have enough money to cover all the failures. The government has to step in with emergency measures, bank holidays, withdrawal limits, deposit freezes. The credit system seizes up. The economy crashes into deep recession. This is a nightmare scenario. It's low probability but not impossible. And the longer the underlying problems remain unresolved, the higher the probability becomes. Here's what you need to understand about deposit insurance. The FDIC guarantees deposits up to $250,000 per account per bank. This makes people feel safe. Your money is protected by the full faith and credit of the United States government. What could go wrong? The FDIC's deposit insurance fund has about $125 billion in it, and total insured deposits in the United States are over $10 trillion. That's a ratio of roughly $1 in the insurance fund for every $80 in insured deposits. If just 2% of insured deposits are at banks that fail, the FDIC fund is wiped out. They would have to go to the Treasury Department and ask for more money. The Treasury would have to go to Congress. Congress would have to authorize emergency funding. This takes time. During that time, depositors at failed banks would be waiting to get their money. Businesses couldn't make payroll. People couldn't pay their bills. And the economy would seize. Up in March 2023, when Silicon Valley Bank and Signature Bank failed within days of each other, regulators made an extraordinary decision. They guaranteed all deposits, even the ones above $250,000. This prevented panic from spreading to other banks, but it set a precedent. The government essentially said, we will protect all deposits at banks that fail, regardless of the insurance limit. This created a massive moral hazard. It told banks they can take risks because depositors will be protected no matter what. And it created an unfunded liability for the government. If multiple large banks fail, the cost of protecting all those deposits could be hundreds of billions or trillions of dollars. Who pays for that? Taxpayers. Just like in 2008, the banks made the bad decisions. The executives got rich, and when it all fell apart, the taxpayers funded the bailout. But here's what's different this time. In 2008, there was broad public support for saving the financial system. People understood that letting the banks fail would cause a depression. There was political will to do whatever it took. In 2026, that political will doesn't exist anymore. Half the country is furious about inflation and blames the government for reckless spending. The other half is furious about wealth inequality and blames the banks for rigging the system. Nobody has any appetite for bank bailouts. If Congress has to vote on emergency funding to save failed banks, it will be a political nightmare. The debate will take weeks, and during those weeks, the panic will spread. More banks will fail. The crisis will deepen. By the time Congress finally acts, the damage will be catastrophic. Let me show you what you should be paying attention to. Watch the deposit flows. Every quarter, banks report their deposit levels. If you see sustained declines in deposits at regional banks, that's a warning sign. It means depositors are moving money to larger institutions or to money market funds. Watch the bond portfolio disclosures. Banks have to report their unrealized losses in the footnotes of their financial statements. If you see those losses growing, it means the problem is getting worse, not better. Watch commercial real estate delinquency rates. These are reported monthly. If delinquencies start spiking, it means property owners can't make their loan payments. That leads to defaults, which leads to bank losses. Watch bank stock prices. The market often sees problems before regulators admit them. If regional bank stocks are falling while the overall market is stable, it means investors are worried about those specific banks. To trust the market, it's usually right. And most importantly, watch what bank executives are doing with their own money. If CEOs and board members are selling large amounts of stock, that's a massive red flag. They have access to information you don't. They know what's on the balance sheet. If they're selling, there's a reason. Don't ignore it. The executives at Silicon Valley Bank sold tens of millions in stock. In the weeks before the collapse, they knew something was wrong. They got out while they could. Ordinary shareholders and depositors didn't have that information. They got destroyed. The same pattern plays out at every bank failure. Insiders know, insiders sell. Outsiders lose everything. 3 major bank collapses in American history: Continental Illinois in 1984, Washington Mutual in 2008, Silicon Valley Bank in 2023. Each time, the banks knew they were in trouble. Each time, they hid the problems using accounting tricks and regulatory loopholes. Each time, by the time the truth came out, it was too late. We're watching the same pattern play out again right now. Over $1 trillion in unrealized losses on bank balance sheets, hundreds of billions in commercial real estate loans going bad, a deposit base that's fleeing to money market funds, and too big to fail banks. Regulators who know about the problems but hope they can manage them quietly, without causing panic. It's the exact same playbook, and history says it ends the same way. Not gradually, suddenly. The banks aren't going to warn you. They're going to keep reporting healthy earnings based on accounting rules that let them hide losses. They're going to keep paying dividends to shareholders as long as they can. They're going to keep reassuring depositors that everything is fine until the day it isn't, and on that day, it'll be too late to protect yourself. The digital bank run will be over in hours. Your money will be frozen while regulators figure out what to do. You'll be standing in line with millions of other people waiting to find out if you'll get your deposits back. This isn't fear-mongering. This is pattern recognition. The warning signs are everywhere for anyone willing to see them. The unrealized losses are documented in Federal Reserve reports. The commercial real estate crisis is playing out in real time. The deposit flight is happening right now. The only question is timing. Maybe we have 6 months, maybe we have a year, maybe it happens next week. Nobody knows exactly when the confidence breaks, but the mathematics say it will break. If this analysis showed you something the mainstream media isn't talking about, if it helped you understand the crisis that's hiding in plain sight, subscribe to this channel. Because when this situation unravels, and history says it will, you'll want to understand what's happening and why nobody in power did anything to stop it. Drop a comment below with where you're watching from. I want to know who was paying attention when the warning signs were everywhere but the headlines were silent. The people running these banks know the truth. The regulators know the truth. They're not warning you because the truth would cause the very panic they're trying to prevent. They need you to keep your money in the system, to keep trusting the banks, to be the last person holding the bag when the music stops. Don't be that person. The $1 trillion crisis isn't coming. It's already here. It's just hiding in the footnotes of financial statements and in the held-to-maturity accounting loopholes that let banks pretend losses don't exist, and when those losses can no longer be hidden, when depositors start asking questions, when the confidence breaks, we'll all learn the same lesson that every generation learns. The banks always know before you do, and by the time you know, it's already too late.